What's going on, everyone? My name is Nicholas Merton here from DataDash, and today is August 11th of 2023. Well, folks, I hope you all are having a fantastic day wherever you are, because in today's video, I want to spend some time to talk about how I believe markets are about to break. We not only are going to be analyzing the price action of Bitcoin and Ethereum, but we've got to spend some time to dive into the macro perspective. We need to look across the board in equities or US stocks, bonds, commodities, the whole macro perspective that so many people are ignoring at the moment that is truly going to determine the direction of cryptocurrencies and the broader value of assets as a whole. There's a lot going on behind the scenes that's not getting talked about, and we're going to break it all down here in today's video. So if you guys happen to enjoy the rambling, consider dropping a like. It's one of the greatest ways you can support the channel, and let's go ahead and kick off the conversation. All right, I want to go ahead and start here by talking about Bitcoin. Now, essentially speaking, Bitcoin has been kind of the safe haven or leading asset when it comes to cryptocurrencies. Altcoins, as we've already discussed many times, have continued to set lower highs and lower lows. That's kind of a topic that I think is already set in stone, and that is going to move back down towards its prior lows and probably set in new lows as sentiment is completely shot in the market, as well as liquidity is relatively dry. But I want to spend some time here to talk about Bitcoin and the significance of Bitcoin's price over these past couple weeks, because while volatility in Bitcoin has been relatively low, while Bitcoin has not been making any significant moves to the upside or downside, bulls are not showing up to the plate, the bears are also not really taking the lead yet, and our momentum indicator is still blue here at the moment. We are just a few $100s away from this indicator flipping back in the red. And the more important thing that I'd actually like to focus on is the ascending channel that bulls have been able to keep up since back between the relative highs in October and relative lows in November. Essentially, we've been able to keep in this ascending channel that has led many people to believe that we are in a new bull market. If this channel does not hold, if we not only face resistance at this price range, the 28 to 32K range for price for Bitcoin, that was the prior support in the last bull market, if we cannot clear through that range, similar back to April of this year, and we start to break through the ascending channel to the downside, this is going to catalyze a big move. And I'm not just talking about some kind of pullback here towards 25K. Maybe that's where it goes first. But I think that this is a very clear sign that we are not able to clear through a critical level that we need to clear through in order to reach back towards the prior all-time highs and really go into a full swing bull market. It means that we've got more capitulation to come, not just down to, say, 25K, but also coming down to 21K, potentially even having the macro environment to get back in this descending accumulation channel and reach down to new lows. I know it sounds too far-fetched, but the more we dive into the data here, it's going to make sense here, guys. Take a look here at ETH to BTC. Now, ETH obviously has been getting a lot of people bullish because of EIP 1559, ETH moving to staking versus proof of work, which reduces the inflation rate. And even with all of these traits here, Ethereum is still not getting the demand to fight against the sell side pressure, the supply that's entering into the market. It has been continuing to decline against Bitcoin here since as far back as December of 2021, or if you want to be more particular, here in September of 2022. It is not getting a bid here. And if we go to the USD chart for Ethereum, as you guys probably remember, we've talked about the fact that Ethereum cannot get through a more than year-long ascending triangle. This is, again, a bullish pattern, mind you. So we should expect essentially that there be a breakout by now, that there should be some move. But each and every time, similar to back here in April of 2023 or August of 2022, or here in July of 2023, every single time, $2,000 has been a supply side range for Ethereum. It means there are more sellers than buyers. And unfortunately, when the bulls need to show up here to signify that we may be in a bull market, they're not coming in. So this is already devastating for the crypto space here. It already tells us, it should give us some hints here that something is wrong. But let's go ahead and step away from crypto for a moment, because when we look at the macro picture, unfortunately, I would say over 90% of crypto analysts out there, maybe well-intentioned, good people and stuff, they're unfortunately not considering that macro perspective. And that's going to give you guys a very skewed opinion of the market. We have, over the last 12 years in my personal trading journey, and outside of that as well, here on this channel for the last 6+ years, we have focused on the macro perspective. And that gives us a cutting edge advantage here about what's going on here when it comes to crypto prices, especially as crypto becomes a global market. We cannot believe in the fallacy that Bitcoin is going to be some asymmetric market so long as the world is operating as it is, and there are still fluctuations in trading going on in traditional equities and commodities. As Bitcoin becomes a larger asset, it is going to probably trade in tandem with commodities like gold and silver, with US stocks, and also the broader risk on sentiment for asset prices. So we need to go ahead and observe these things. The first thing I want to bring your attention to is what looks like a very clear deviation in the performance of Apple and Microsoft. Now, we talked a little bit about this the other day, but it's significant to talk about it now because not only is this looking like a clear deviation from the prior all-time highs, we've now broken down below the prior all-time highs in December 2021. That's problem number one, because deviations like this usually signal that if this wasn't able to be held as support, that prior high range is not new support, we are heading back down to find a new low, and we are going to have to come up and retest that in a couple months' time to over a year. So we've got this problem alone. This is kind of the rule, textbook TA rule here, but outside of that as well, you've got this terrible topping candle here in July where the vast majority of those gains faded. This is a clear pattern here for a retracement. But along with that as well, if you can see here on the chart, our momentum indicator has flipped red. This is the first time that Apple and Microsoft has flipped red since back in August of 2022. Right? Now, it's important to analyze when we say it flips, right? This is again going from a blue pattern to a red pattern. We have not had this since back during the Jackson Hole speech where Jerome Powell put the hammer down and let people know that the Fed was going to get ahead of inflation, that the market's expectations that the Fed was going to start cutting rates as early as 2023 were far-fetched. And it pushed the dot plot for the Fed's monetary policy or Fed interest rate back multiple months, and with higher target interest rates, which we called for over a year now here in this channel. We are still going to talk about that as we go throughout today's video. And if you guys aren't prepared for those higher interest rates, stick around. I'm going to talk about why we need to be prepared. Okay, so essentially speaking, we've got another red weekly candle here after Apple having essentially a negative response to earnings, Microsoft fading off of a lot of the data coming out now that ChatGPT is losing user traffic. It is actually declining month over month. This is again something we hinted in the Dash report as well, our newsletter on the channel, and talked a little bit here about on the channel as well. But it's not just the two large technology plays that are starting to signal signs of weakness. We also have to take a look at the semiconductor sector directly, looking at the plays that are benefiting most from AI, those that are creating GPUs or graphics processing units, right? And we can see here that SMH, or the VanEck Semiconductor ETF, has not only faced resistance at the same range we were at November of 2021, the last bull market, but on top of that as well, that essentially we're starting to roll over here. We are at our lowest price point, back to where we were essentially back in May of 2023. We've essentially cut back June and July and half of August, 2.5 months of price gains here for the semiconductor sector. And that's mainly been led by NVIDIA continuing to pull back here. We can see that NVIDIA has had 2 negative weeks, cutting back about 10% from the all-time highs. And this looks like we might finally be seeing a topping pattern. We're finally back to where we were back in early June, again, cutting back 2 months worth of price acceleration. Not a good look here. We're finally getting the bears leading here on equities. We're finally starting to see some price retracement, some profit taking after these enormous moves. And the question we got to ask ourselves is that as NVIDIA is at this $1 trillion valuation still at current prices, whether or not the earnings report that's coming out in the next couple of weeks is going to be able to hold up. Is artificial intelligence or generative AI the new trend? Is this really going to be able to hold up NVIDIA at a $1 trillion valuation? Is NVIDIA really going to deliver on its promise of $11 billion in quarterly revenue? And even if they do, can we continue that kind of demand? Is generative AI going to be something that is in such high growth and high demand, as so many of the experts are saying, that essentially quarter by quarter, year by year, it's no longer going to be gaming demand here for GPUs or traditional server infrastructure. It's going to be about generative AI. Is the demand really there? Because ChatGPT is not showing it. Bard, all these tools, Midjourney, while they're being used, they're not growing in their adoption month over month. We had negative month over month growth the last 2 months when it comes to AI products. What does that tell you here, guys? It tells us that there are clear flaws with this technology. It is not as much as it was hyped up to be. And even if it is going to have potential, it's going to take practically 5 to 10 years to really make this something that completely disrupts the world. Similar in the fashion of the internet or again, mobile phones as we move towards smartphones, right? It takes time for these technologies to evolve. I know it may not seem like that. It may seem really flashy and exciting now, but similar to crypto as well as an industry, which had so much promise over the last couple of years, we realized it still has a lot of bottlenecks when it comes to DeFi and GameFi and NFTs. These narratives might hold weight in the future, but it takes time to really get through the problems, whether it be security, whether it be user experience, in order to really accelerate those technologies. Take a look here at XLF. This is the broad financial sector ETF created by SPDR Spider. And essentially we can see that since December of 2021, we've been on a decline here. We've continued to set lower highs in, and we faced similar resistance here on the XLF ETF that we did essentially back in June and also July of 2022. We didn't even come up here towards the range we were chopping in between the close of 2022 and Q1 of 2023. This is likely led due to weakness not only in the regional banks, or IAT, that's the main ETF for the regional banks, all those that were overexposed to fixed income products and have been kind of caught in this trap with high interest rates, but along with that as well, we essentially are starting to see weakness in some of the bigger plays. All of those plays that so many people think are going to be adopting crypto and offering crypto products, for example, like BlackRock. BlackRock is losing out against the broader financial ETF here for financial companies. It has continued to move lower, as you guys have probably seen in the last couple episodes if you watch the channel frequently. And also we're seeing broad weakness in other financial players and large banks, at least over the past month. If this continues to keep up, if we can't clear through these resistance points, it's an ample opportunity to short and bet on lower prices over the next couple of weeks. The trend will start to become clear. Now, taking a look at the broad indices here for the NASDAQ and the S&P 500, we can see the NASDAQ had a superb rally here, 43%. Almost leaves you to think that we have to be in a bull market, that it has to be this period of time where we're just going to continue surging higher to new all-time highs, and it's a return back to the normal. That's exactly how deceiving relief rallies can be, folks. And I know some people will tell you out there, oh, 20% correction or 20 or 30% correction, that's a bear market. And essentially if we recover a certain amount from those lows, it's a new bull market. Guys, if you get caught up in these kind of like textbook definitions and don't know about how they can be used against you, you're going to get chopped up in the market. You're going to be buying into a relief rally and get caught selling those assets probably at a lower price as you panic sell. I'm not saying that about you personally. I'm saying that as a friend here, that there's so many people, including myself, who have gotten caught in these kind of fallacies in the past. Essentially speaking, this is pretty predictable resistance. We came back up here towards the same price range we were at in February 2022 and March of 2022, and we didn't get a bid. We got clear resistance. We got continued downside, and for the first time back here in early August, back about a week and a half ago, we got a red flip on our momentum indicator, the first time since back in May of 2023, right? And this is really the longest period of time since back in February. So this is the first time in multiple months, over half a year, that we're really starting to get the bears leading here on the daily time frame. And it's not just in the technology place, it's the same exact thing happening here in the S&P 500, moving in tandem here, facing resistance at that pair of highs, relative highs from February 2022 and March of 2022, and really providing some significant downside here that is starting to signal that the trend may be fading here. Now, here's the good news. If we take it here to the weekly time frame for the bulls, right, we've got a long way to go until we get towards those moving averages. But the momentum indicator here that we utilize on the channel is still signaling a blue flip. The bulls are still in charge right now. That being realized, right, we are starting to see those initial signs of weakness. And I want to tell you guys, we got a lot of things going on here, not just in equities, but going on in commodities. You guys might remember about a week ago, we talked about oil and natural gas and the resurgence of inflation. We have, for nearly probably 6-9 months now, talked candidly about the battle between the 200-day moving average and the 200-week moving averages for oil. And while so many times it looked like oil was going to break through that 200-week, which would have been the confirmation that the Fed likely has won in its fight against inflation, if it would have stopped pausing interest rates so immaturely, so worried about pleasing the stock market, if it had stopped saying things like inflation was transitory, that essentially this was going to be a slam dunk, if they would have gotten aggressive, if they would have done the 50, 75, and 100 basis point increase, if they would have contracted the balance sheet more aggressively, similar to their counterparts and the European Central Bank, right, doing multi-$100 billion reductions on a weekly or monthly basis, if they would have actually attacked inflation and been the leader in the fight against inflation, we could have knocked oil down there. We could have contracted demand. We could have gotten this out of the way and really had the foundation to potentially start a new bull market. But the Fed didn't do that. They paused. They gave signals that they might pivot. They let financial markets get ahead of themselves and people to speculate on new narratives like generative AI that don't have the weight to kick off a new bull market. And what happens here? Well, when all that excess money is still in the system that you didn't remove, you get multiple wicks here that do not close below the 200 week, and you get oil breaking above the 200-day moving average. Not a good sign, because that shows that oil bulls are in charge. That means oil prices are moving higher. They are likely going to triple digits again per barrel. And what is that going to do? It's going to boost up inflation. That CPI reading that so many people are so goosed up to see hit 2% is likely not going to do that if oil, natural gas, and broader energy costs start to go up. Because this has been the one thing that has helped inflation reach close to its target at 2% on an annualized basis. This has been the one thing providing support for the pivot crew that essentially things are going to get better soon. But with oil and natural gas starting to move up here, this is not a good look. Natural gas is up, practically speaking, 50% off of the lows since back in April. And it looks like it has the steam here with higher lows and higher highs to continue at a minimum coming up to test that 200-week moving average, which means that natural gas is going to expand another 70+% here from this price range. It's not a good look here in the fight against inflation. Excuse me, another 40% here up towards that range. Got my math wrong there. But you guys get my drift here, essentially. This is not good news here for those who are long on commodities and cryptocurrencies. We have got to be cautious here about what this is going to mean for the Fed's next move. And it's not just my kind of concerns here. This isn't just me being some doomsday prepper or viewing things from a perma-bear perspective, guys. I'm not a perma-bear. I'm ready to go long on equities when I get the right signs and when we have the real foundation of capitulation and the beginning of a new secular bull run, right? Where liquidity is on our side, the narratives are solid, there's real exciting companies that are starting from the ground up that are going to become the next Googles, the next Apples, the next Microsofts, the next NVIDIAs, right? And they may be out there in the wild, some may be smaller, some may be larger, but they are likely not going to be the same plays. They're not going to be Netflix, they're not going to be Amazon, which reached peak growth in 2020 and 2021 during the pandemic. We've got to find new market leaders, and I'm not seeing that. I'm not seeing them. We find them when there's capitulation in the market and which plays are holding out strong. But generally speaking, again, these are not just my concerns, guys. Take a look here at what's going on in Forex markets. Now, when we take a look at the euro to USD here, I'm noticing something really interesting. There's been this price channel that has been really historically significant since back during kind of, we can even stretch back here just to kind of showcase here, this descending line of support for the euro against the dollar that essentially has been in play since 1995. This has been a significant range to watch each and every time. It was where we got the bounce here in July where the dollar started to weaken and the euro strengthened. We saw it here in October 2016. We saw it in 2006. In October 2005, and also here as well in October 2003 and back in 1995. This range of descending support for the euro has been an incredibly significant range for the long period of time that the euro has traded against the dollar. And essentially speaking, each and every time we came out of this channel, we came out weaker and weaker and weaker over time. All right. The response here, this is the quarterly chart, just to explain here. So each of these candles is a quarter. As you can see, we're looking over multiple decades here for the euro against the dollar. And we can see that while we had a nice little rebound here out of there, we've had a completely weak response here for the last 3 quarters. A 1.3% move, a 0.6% move, and a 0.79% move. Last time we came out of this channel, we had a 7% move, a 3.4% move, a 1.6% move, and a 2.3% move. Either way here, we've been setting lower highs in the euro against the dollar, And the response of buyers coming into this descending line of support has been weaker and weaker every time, with a pretty clear topping candle here that's starting to form here in the quarter of July. So I want to ask you guys a question here. If the euro can't get a bid here, right, the second leading world reserve currency out there, again, Eurozone here being the second largest, kind of economy. Probably if you're including the Eurozone as a whole and stuff, it's on par with China and the United States to a large extent, right? So you've got this huge economy here, right? And its currency is not catching a bid against the dollar, even with the ECB's tightening efforts. What does this tell you that Forex markets or foreign exchange markets think the Fed is going to do? Currencies garner strength with tighter monetary policy, because with tighter monetary policy, with higher interest rates, which is the cost to borrow capital, and along with that as well, a reduction in the balance sheet, this means there's less of that currency in circulation, meaning that there's less supply out there in the market, meaning that it's more scarce. So the markets are saying, they're either believing one of two things, or maybe even possibly two things at once. They either believe that the ECB is going to have to stop its quantitative tightening program and the Fed is going to have to continue, or that the Fed is going to really pick up the pace much faster than the ECB. If this starts to roll over, that's your telltale sign that the dollar is going to get stronger. And maybe worse off, perhaps both of those things are happening. Maybe the ECB can no longer tighten anymore, and the Fed is going to have to get really aggressive. If that is what's happening here, the dollar index, which has been moving up here since mid-July for over a month now, is going to start breaking through some of these lines of resistance. In the same fashion that Bitcoin may start to break down through its line of support, the Dixie may be clearing through resistance and starting to head up towards new relative highs, or potentially come up practically back to the all-time highs here, or at least the all-time highs of this last run. All right. So if the dollar does that, right, again, I want you guys to consider the ramifications here. If the dollar starts to clear these ranges, even if it comes up to, say, our short-term target of 106, or it starts to come up here towards the prior all-time highs, that's a huge acceleration in the dollar against global currencies. It's a sign that liquidity has got a long way to go before it's done contracting. And this brings me back to the ultimate topic, unfortunately, that so many people miss out on. That with these moves, right, these kind of generational moves, they take a long time to play out. It always comes back to the topic of liquidity. Now, you all have probably seen this chart. This is the federal funds rate. And for the last 40 years up until 2020, so from 1980 to 2020, we essentially were going towards a declining interest rate environment. This was a phenomenal period for financial assets, for the broader financialization of the economy. The financial sector did great. Technology stocks did wonderful. Anything that had to do with growth did wonderful. A ton of great innovation came during this period of time. Innovation that has made our lives so much better off than it was before. Again, I understand technology has its downsides, but essentially speaking, right, this was the good period. This was a good time for assets. It fostered new asset markets like crypto during this period of time, and it also allowed for dozens upon dozens of leading technologies, semiconductors, smartphones, the internet, social media, web applications, digital advertising, all these new revenue streams to open up and create some incredible things through various different companies. What we are going through right now, and so many people have not talked about this, we are now in a new range of expanding interest rates that will likely be here to stay for a long time. So many people believe that it's going to look like this. Right? Maybe we hold sideways here for a little while, and then sometime, even actually shorter than that, sometime in early 2024, that's the expectations right here. Market thinks the Fed's going to do something like this. If you look at most of the dot plots, if you look at most of the economic projections, that is what people think is going to happen. And suffice to say, I bet many people think the Fed is eventually going to do that and then do this and then keep interest rates back at 0%. It's just only doing this because it has to tighten inflation. That's the only reason the Fed is using these tightening mechanisms. I want to ask you guys here, do you genuinely believe that this is how it's going to play out? Because unfortunately, it's likely not going to play like that. It is likely going to mean that we have to move higher here off of the data we just talked about today, the Fed is going to move towards a higher target rate, its highest rate in nearly 30 years. But on top of that as well, it is going to have to keep in that range for a longer period of time. Right? I'm not trying to say that we're going to be up here and we're going to stay up here for decades to come. What I do believe is that we are going to have to come up here in a relatively short period of time, up into this range between 6.6% to 8.3% for the federal funds rate. And I think that while we are going to have a decline afterwards out of that range, it is not going to move all the way back down to 0%. It's going to stay up in this range, guys. The Fed cannot just get to 2% and then say that the job is done. There will be chops and waves. Look at history here when we go through these expansionary cycles for interest rates, right? The economy grew. It did good during this period of time, right? But still, it's important to understand here on our thesis here, right? We are not perma-bears forever, but we do believe that we still need more tightening to go, and that likely means we don't have our bear market lows in. And that's the ultimate question we're trying to answer here, guys. Are we really ready for a new bull market? I don't think so. Not in an environment where we're at 30-year interest rate, and we're going to be essentially at 30-year interest rate highs potentially by the time this is done. And we're essentially back in a range that we've been in since back in the 90s and 2006, where the global financial crisis happened. I don't think it's going to happen when the Fed is continuing to remain on autopilot on tightening and probably still has a long way to go between our target of a 20% reduction from all-time highs to practically a third of the entire money supply. This is our band here that we're watching for. And the Fed is playing catch-up because, unfortunately, in March, it provided that short-term stimulus that made so many believe we had a new wave of QE. You remember how people were saying that? That it was a new wave of QE. Some even said QE light. That essentially that we were going to go back to the good times. That it was going to be enough to spark a bull market. Yeah, $400 billion of liquidity and a sea of, at the moment, $8.3 trillion of liquidity back then. Is that really enough to spark a new bull market? Less than a 5% expansion of the money supply? I gotta tell you guys, the narratives have gotten so tiring. And I understand here as well that it probably gets tiring that I'm viewing things in what may seem like a very negative light, but I'm just trying to be realistic with you guys here. Times aren't always good, right, when it comes to financial assets. Doesn't mean the sun isn't shining outside. Doesn't mean that there aren't great innovations in the work behind the scenes. We have many sectors that we're excited about outside of crypto, and even crypto itself at lower prices that we think are going to do well. But when you have global liquidity contracting like it is right now, when we, for the first time on the quarterly chart here for global liquidity, are about to flip red. This is, again, our exclusive version of our momentum indicator here. Give you guys a little sneak peek. It's something you get access to within the Dash report. We are about to, essentially, if we move down a couple hundred more bucks or just keep sideways here for the next quarter, we are about to see global liquidity flip red on our momentum indicator for the first time in the last decade. 10 to 11 plus years. An easy, fun ride where liquidity was the sugar rush that drove asset prices to new highs, that helped foster crypto towards becoming a $2.53 trillion market in the last bull market. That liquidity is not coming back, guys. At least not now. It's not just me saying it, it's the trend. When you see global liquidity contracting like this and only expanding less than $1 trillion each of these quarters, but then coming back and wiping out all of those gains and still not getting a bid here in the next quarter of July, that tells you we're about to enter into no man's land. We're about to fill in some of these gaps here. We're about to remove a couple more $1 trillion of liquidity. The Fed has got to get inflation below 2%, and it's got to get it close to having 1 or 2 months of deflation. It's got to send a signal here that inflation is done with, that it is no longer a part of the picture, for it has removed the money supply, the excess money supply that does not belong in the economy and probably didn't belong in the economy in the first place after expanding this secondary wave of liquidity that it so necessarily needed to get rid of back over the past year or so, and it needs to get at a more aggressive rate than it is now. I know, guys, it's not fun to realize this, but the good times are up here in the near term. And if you caught the wave on the AI stocks, or if you bought Bitcoin at 14K, hey, that's great. Awesome that you made some profits. I'm not here to bash anyone for that. And I'm not here to say that we catch every single move in the market. That's not our job. Those who chase every single opportunity will eventually get chopped up. Those who know how to set the standards for when they make entrance into the market and remain patient and vigilant, those are the ones who hedge and protect their capital. And those are the ones who are going to still be able to capture the vast majority of new bull markets, the vast majority of new upswings, and those who are quietly doing their due diligence right now to find those next trends are going to be making not just a 100% move if they time the absolute lows and the absolute relative top. They're going to be the ones that easily capture and accumulate positions in markets that do a 5x, a 10x, a 20x, a 50x over the next coming years, and heavily outweigh the S&P 500 and the NASDAQ. If you are one of those investors, if you are one of those individuals who wants to capture those major moves, who still believes the time will come to make those generational returns, then I highly recommend you guys check out the Dash Report. Now, I can't guarantee you guys here anything around returns, or I'm not here to say that. What I'm essentially saying is that there are some markets out there right now. Unfortunately, they are not cryptocurrencies, as much as we love covering crypto here on the channel, and I think crypto does have potential as an industry. They are markets in equities and a whole range of other areas like commodities that could make some substantial moves over the next couple of years. There are clear trends that are starting to signal in the market that we are getting bullish on here over the next couple of years. And while we may not be accumulating them right at this moment, it's the time to do research and wait for those price targets to start accumulating heavy into capitulation, building sizable positions so that we can make those generational returns that we're so looking forward to making. For me, it's a game at the end of the day, guys. I want to win out in the market. And if you guys are interested to see how I'm actually going about winning in this market and getting access towards our newsletter, our trade alerts, our exclusive market updates, our mid-month webinars where you can ask me questions and I'll give you guys answers to my thoughts on the market, and our Dash Report discussion group, and so much more, then check out the link down below in the description. You can get 20% off if you sign on an annualized basis. And on top of that, get to interact with hundreds of great members from our community, some of the top cream of the crop members from the Data Dash community. So that being said, if you guys are interested to get access to the momentum indicator, if you're interested to get access towards our trade alerts, if you're interested to interact with some of our prime members in the community, check out the link down below in the description. But even if you can't subscribe to the dashboard, guys, if you can, at least consider dropping a like. It's one of the greatest ways you can support the channel. And until the next video, everyone, have a wonderful weekend. Have a great Friday, and I'll see you guys in the next video. Take care, everyone.